Good afternoon, folks. I'm Dave Burrows, Chief Strategist at Barometer Capital Management, and I want to thank everybody for joining us today on this Tuesday afternoon webcast. I hope everybody had a great Valentine's Day. We're here on February the 15th, into the meat of winter, and it's been an interesting week in the market, so we got lots to talk about. Why don't we just jump right in, see if we can't get through the content in a timely way today. Just quickly, starting from the top, we continue to be in a secular bull market. We've been working our way higher in a series of sort of 3 steps forward with 1 step back, which tends to be the case in the structural bull market. We've had a tailwind in U.S. equities since 2013, with a few brief interruptions. Not to say that they aren't painful, but they tend to come and go quite quickly. And I think that we've been going through another one of those over the last few months underneath the surface in some sectors of the market, where the broad market overall has stayed in pretty good shape. We've certainly seen some broadening into other global markets over the last while. We're seeing some improvement in a number of areas in the world. So that's going to be an interesting topic for conversation today. But in general, the equity asset class continues to be the beneficiary of flows working their way into the market, looking for assets that might do well in a slightly more inflationary world. If you take the S&P 500 as an example, just to put sort of the time and magnitude in context, the last structural bull market went 214 months. The total return for the S&P was about 1,000%, or about a 10-bagger over the period from 1981 through 2000. Now, since 2013, the S&P is up about 188% off over that period, over 106 months. So you can see both in time and amplitude, it's been a good market, but it potentially has a long way to go if it looks like other structural bull markets we've seen over time. It looks very unlike a structural bear market, which is what we had between 2000 and 2013. And like other bull markets, there have been brief, sharp pullbacks, 10, 20, 25%. We had certainly a good size pullback in January, February, March of 2020. But like in any bull market, these corrections, when they end, get righted quite quickly, and we're on to make new highs. So just to put that in context, to move on, we talk about rates for a second. Long-term interest rates have been falling since 1981. We've been going through a structural bottoming, we believe, in the interest rate complex, much like we did in the early 1950s. And when that took place, it took several years for that bottom to get put in place. In fact, I think that we were going through that same process from 2016 through 2018. And of course, the pandemic came in 2020, took us to new lows. So let's just start there. 10-year yield continues to work its way higher. We were at 50 basis points back at the COVID bottom. As of today, we're through 2%. We're about 2.04, I think, around the close today. And importantly, as it would often happen, you had a rally in rates. We consolidated through the course of spring, summer, and then resumed the rise. And certainly in the 10-year area, the 30-year area, so on, rates have been going higher. They've been going higher, not just in the US, but in Japan and in Germany, really around the world. The advent of negative interest rates really has now gone by the board. Virtually all of the major countries have yields back above zero. And there's very clearly, we've been in a bond bear market. If you look at the aggregate bond index, which takes maturities from the shortest maturities at 1 year out, all the way out to 30 years, the aggregate bond index since the top is down about 9%. Frankly, since the middle of December, down about 5.5%. And that adds on to the losses from last week. So not a great thing to have happen to folks who are focusing or supposed to be focusing on these as an income generating asset. I think one of the reasons there's so much money been in the bond market over the last several years is, yes, people were getting their coupon, but bonds were appreciating as rates were dropping. Now, on the other hand, when you look at, say, a 2-year bond that was yielding 20 or 30 basis points last summer, and it's now yielding north of 1%. Means that the price of the bonds have been dropping and offsetting what you might make in the way of a coupon. So if we take the 30-year bond or the 20 to 30-year ETF, the TLT from the top has fallen now about 25%. So that's a big loss for a bond investor. And just since the middle of December, down 12.95%. And here we are sitting right down on the lows. I'm going to guess that it is likely that ultimately we break these lows and prices for the long end of the bond market continue to fall. So that raises an important quandary for those investors. Yes, they're looking for income, but they're losing from a capital perspective. And so we think that we have begun a period where we will see those who can leave the bond market slowly reduce their holdings and look for income in other places. And our premise has been we need to own things that do well in rising interest rates, and bonds clearly are not one of them. So money continues to move. Now, we've seen some money come out of the long end of the US bond market. There's that same TLT chart, but we've only just started to see flows come out. And we think that that could go on for quite some time. So this is why I think ultimately we probably break these recent lows, because as time goes by, lots of bonds are going to continue to be issued. The Fed has made it clear they're not going to be buyers. And so the market is going to have to take up the mantle of buying treasury bonds. US government bought almost all of the bonds that were issued last year. The Fed has bought almost all the bonds that were issued by the Treasury in the past year. It's going to be big shoes to fill. Moving on to commodities, we've been making the case that we've also gone through a generational bottoming in commodity prices and commodity producing companies. The 10-year total return earlier this year traded through the zero line. In other words, the previous 10-year return was 0% per year, up from almost minus 9% a year. But like in other periods where this took place, it often could go on for a long time. By the time we're done, we may see, 15, 18, 12% annualized returns for the previous 10 years. So this could be quite a fruitful period to be invested in basic materials. And that would make sense if we think we're in a more inflationary environment. So the Rji Index, which is the Rogers Commodity Index, an unweighted basket of commodity prices, after falling 77% from 2008 through 2020, has been slowly ratcheting its way back higher. We think that that likely continues, and that continued over the last couple of weeks, despite some shakiness in global markets. The relative strength for the RJI versus the S&P 500 continues to climb. The price of commodities has been rising faster than the S&P 500, which is a pretty significant change given that stocks have outperformed commodities for many, many years. When we look at the S&P 500, over the last few days, again, a little bit of choppiness coming into Monday and concerns that Russia may have ulterior motives in having their troops lined up across the border, around the border of the Ukraine. Lots of discussion, lots of politics involved. We closed today back above the 200-day moving average. That's a positive. When we look at the Nasdaq we know was down more from the middle of December, down about 18% off the highs. And as we talked about last week, has been unable to regain the 200-day moving average and continues to underperform the S&P 500. So we've had a long period of outperformance in tech. The large cap tech companies are broadly owned. They certainly have provided good returns over time, but we're now at a point where investors who have been buying the Nasdaq 100 really since last summer are broadly underwater, and may well be that some of those folks would just like to get their money back should we trade back to prices that they paid. And so over time, it becomes increasingly more difficult for tech to regain its footing. On the positive side, if we take the equally weighted S&P 500, an index made up of 500 companies, each one about 0.2 of 1%, you can see that it's actually behaving even better than the S&P 500 itself. So while the S&P corrected almost 13% from top to bottom, the equally weighted index pulled back 9.8, has regained much of that pullback and sits comfortably above the 200-day moving average and better than the cap-weighted S&P 500, means the average company is trading better than the biggest stocks in the index, and that's quite different than what we've seen over the last few years. So there's that equally weighted S&P 500. You can see the relative strength line down here rising, meaning it has been outperforming the S&P 500 since the end of November. And we've been talking about the fact that we're seeing improvement across a bunch of global markets versus the S&P 500 since then. Going back to the bond market, a few things that we can take away. Last week was tricky because there were geopolitics. And certainly by the activity of investors, there were nervous people. Friday, there was a tremendous amount of put buying. If you looked at the volumes of put options in the market, they really went through the roof, concerned that there might be war over the weekend. A few things that caused us to be less concerned. First of all, if you're going to get into some kind of broader correction, there are things that you expect might happen. One of which might be that people would jump into the safety of bonds. Well, as you can see in the TLT, certainly nobody jumping into the safety of bonds, if anything, probably lightening them up. Another thing that might happen is that money might flow into the US dollar, which is often seen as a safe haven. So this is the Dxy Index. It's the US dollar versus a basket of world currencies. We know that when the market was pulling back in January, the US dollar did surge to a recent high. But on the renewed geopolitical concerns last week, the US dollar was unable to make a new high. So again, a safe haven asset that didn't act like people really needed a safe haven asset. In fact, you can see that each one of the most recent pushes higher has been with less oomph behind it. So the relative performance versus other assets not really increasing, which means that the strength of the push higher is actually becoming somewhat less reduced. Another asset that would likely be spiking if we were headed into a real problem is volatility. We know that at the end of January, the VIX index, which is a measure of volatility in the market, traded as high as 38 on the pullback last week. We pulled back Friday, we moved Friday up to 32 and sharply lower today, about 10% lower in VIX, which means some of those concerns coming out. So bonds, US dollar and VIX, none of which pointed to a continuation lower for asset prices. So let's talk a little bit about what happened this week. In the past week, we had the CPI data. Again, it came in hot, 7.48% year over year. You can see by the makeup of the inflation data, really it came across the curve, but a lot of it in the core. This has been a concern for the market, not because there is inflation, but because of the speed of the pickup of inflation, which means that people have to change their opinion and change their position fairly rapidly. This creates uncertainty, and the market doesn't like uncertainty. But also this past week, when we look at the New York Fed survey of consumer expectations, actually 1 year ahead and 3 year ahead, expectations have started to pull back for inflation. So we know there are things that are inflationary that may stick in the numbers for some time, but we also know there are some things that may not stick. Some of the shortages slowly may clear, and some of the supply chain problems might improve. But perhaps it is that the market is now priced in a series of interest rate increases, has priced in inflationary concerns. And perhaps it will be like after the Second World War, we'll get a year or two of higher inflation before supply can come into the market and bring some of that inflation back down. From an earnings perspective, Earnings continued on this week. We're now 360 companies out of the S&P 500 that have reported sales growth on average up 16%, earnings growth up 26.9. These were largely expected numbers. Certain sectors much stronger than others. You see big earnings increases for materials and for industrials, big revenue increases for energy, and certainly big earnings increases as well, but versus a negative number, really hard to measure. When we look at the sales surprise, about 3% sales surprise, which was about where we were last week, a little bit better overall, and the earnings surprise about 6% ahead of estimates. You can see that those beats are slowly coming down and becoming more normalized. Looking at it another way, the earnings surprise factor for the S&P 500, you can see the market analysts and participants are feeling somewhat less confused, and the beats are becoming more normalized. So the market likes to see things normalize. We like to see less uncertainty. It helps investors make decisions when they feel like they are getting a better grasp of the numbers. So certainly I think that is a positive. Now, this is the big one. Over the last week, we had lots of geopolitical machinations, lots of concern that Putin was preparing to run across the border into the Ukraine. It may well be that he had those kinds of designs. It may well also be that this has been political theater to try and create higher energy prices, where certainly Russia has a very weak balance of payments, needs higher oil prices. It may have been for political gain to help suggest that the Ukraine should not be allowed to enter into NATO. But the net of it is, over the weekend, Russian troops started pulling back from the border, and the market sighed a breath of relief. So look, there's a lot of things that impact markets. And we know that when we go through a weak period, the things that are closest to the problem sell off first, and eventually it will get to a broader and broader list of assets. When things start to improve, the strongest securities improve first. And as time goes by, pretty soon the asset class gets turned around. And when you're in a healthy market, a broader and broader list of securities should be participating in a rally. It may well also be sectors that a broader and broader list of sectors are participating in a rally. And when we're seeing expanding breadth, there are really no bear markets that I can point to that happened during a period of expanding breadth. So this is something that we track across asset classes, geographic regions, sectors, themes, market caps, all different types of universes to try to identify where the flows are going, because we want money coming in behind us in the investments that we own. We spend a lot of time focusing on where breadth is contracting. And so often, again, late in advance, the weakest sectors or themes will start to roll over first. And then if it continues on, it'll one by one get to other groups. So let's talk about our breadth models for the week. First of all, to be clear, the major breadth models that we follow, the percent of stocks in uptrends for Canada, the US, and globally, are expanding. No negative impact from some of the wobbles last week. Our short-term indicators also are broadly positive. In the US, we have 4 short-term indicators: percent of stocks trading above the 10-week moving average or a 50-day moving average. And that did move down a little bit this week. But frankly, the reading is still significantly higher than where we were at the end of January, a couple of weeks ago, when markets were a little bit lower. Percent of stocks trading with positive weekly momentum this week improved. Percent of stocks making new highs versus new lows improved. The percent of stocks trading above the 150-day moving average improved. So 3 of 4 short-term indicators in the US is positive. Our major long-term coach is showing expanding breadth. It means that under the surface, the average company is continuing to improve, and that there's sponsorship and new money getting put to work. Same thing globally and same thing for Canada. So it's not for us to say what should happen, it's to have the tools to recognize what is happening. When breadth is expanding, we're comfortable putting on new positions. We, of course, always have stop losses on each individual position. There are business risks attached to every security. But when The asset class has improving breadth, like equity does. When at the sector level, we have improving breadth, which many do. 80% of return comes from that backdrop. 20% of return comes from us finding the securities, the individual securities to express our view with, to take advantage of those themes. So I would say we come out of this week with all of the moving parts in the market and all of the news with a better position today than it was a week ago. The market is strengthening. When we look around the world, just a couple of important points. All of Latin America has improving breadth. All of Europe has improving breadth. All of Asia Pacific has improving breadth. And all US has improving breadth. The major parts of the world showing improvement. When we look at a sector level, all of the sectors on this chart that are in capital letters are seeing expanding breadth. So you can see only a few sectors now out of 40 are showing deteriorating breadth. Semis is one of them. Forest products saw a little bit of weakness this week. Electric utilities, gas utilities. But those in capital letters are all showing improvement. The ones in green actually are outperforming the market, meaning that they have strong relative price strength. Now on this curve, if a sector was at the far left here, for instance, in this column, it means that only between 16 and 20% of companies within the sector are performing well, meaning not very many. But if it's in capital letters, it's improving. On the other end of the spectrum, for instance, oil has between 68 and 70% of companies in the sector performing well, and breadth is improving. So we use this as a coach to focus on where we want to put new money to work. A few other takeaways. Despite the fact that we are seeing improvements internally, there's still quite a lot of bearish investors out there. So sentiment actually is supportive to the market, meaning if there are lots of people who are bearish, it means they've been cautious and they could change their mind and decide it's time to put some cash to work. We know that cash levels in this past week actually are up sharply from where they were early in 2021. So through the course of the fall and early winter and into the middle of winter, cash positions have been rising again, means that this cash can be supportive and get put back to work in the market. When we look at what hedge funds are doing, they have quite significant short positions, as short as they've been in the last few years. In other words, making a bet that the market's going to go lower. But if the market goes higher, they get forced to cover their shorts. So there's a lot of potential buying out there. There's short covering potential. There's cash. There's $4 trillion in cash. There's been a lot of put buying, and there's a lot of negative sentiment. So these are the things we like to see, because a healthy market has to crawl up a wall of worry. And yes, we have an intact wall of worry. Let's talk a little bit about leadership for the week. Of course, our job isn't to be everywhere. We got to target leadership. When we say leadership, areas of the market that are seeing expanding breadth, where there's a tailwind, where something is good but getting better. We're always looking for new signs of leadership. And every day we go through our process to try and identify those. And in the event that there is no leadership, we're very happy to have cash on the sidelines or sit out for periods of time until we see improving macro factors. So let's just talk a little bit about it. For an income investor, it continues to be that bonds are off limits. They continue to weaken. We looked last week, the aggregate bond index since the middle of December was down 4.7%, down 5.25% since the beginning of December. That's significant, down 8.72% since the top. It's not in international bonds that we're going to focus in. They're down 7.5% since the middle of December, and they've been weakening now for months. We see that money is on a steady state, starting to be drawn out of investment grade and high yield bonds. So we know flows are going against those investors. We know that preferred shares have had a particularly difficult month, down 11% since the early part of the year. We know that high dividend paying stocks continue to underperform. So these are all long duration assets. They're supposed to be predictable. They're tightly tied to interest rates. And with rising rates, it means prices are falling. So we've been advocating for some time buying rising dividend companies, companies with dividend growth. We can see that the relative performance, even versus the entire S&P, has been improving. We're trading very close to the highs and very close to relative strength new highs. Companies that pay a moderate but growing dividend are far more attractive in a world of rising rates than high dividend paying stocks. This is an important regime change. If money is coming out of bonds, it means it's coming out of other long duration assets. If that money needs to generate cash flow, dividend growth becomes the most logical place for that money to go. And that certainly seems to be happening. Within that cohort, certainly the natural resource upstream commodity producing companies like the energy companies and the miners having a very, very good month since the beginning of the year. Now 6 weeks, really sharply rising relative strength versus the market, trading virtually at new highs. We know also high dividend paying and dividend growth stocks in emerging markets are seeing net inflows. Now, this ETF, DEM, trades in a liquid way. It's up 7.7% so far in the year as of this afternoon, pays a 5.4% dividend, and the dividend's grown over the last 3 years by 9% a year. I think that looks very attractive, and this is one of the holdings that we have in our global macro portfolio. From a sector perspective for dividend growth, banks continue to behave really, really well. The ZEB equally weighted basket of Canadian banks has had sharply rising relative strength since the early part of the fall when the reflationary trade took back over again. We know the US banks are seeing rising relative strength, trading very close to the highs and above all of their prospective moving averages. Certainly lots of flows getting put to work here. And around the world, the global banking index has made new absolute highs after several years and is making new relative highs versus the S&P 500. And then following along, the insurance cohort of companies also performing really well, very close to making new highs. Again, remembering that over the past week, the S&P retraced and retested these lows from late January. Each of these groups has maintained strength well above the moving averages and well above their previous lows. I always like to see what is it that can hold up at the first sign of weakness after you believe you put in a market bottom. And these groups certainly have all done that. Moving on to energy, Canadian energy producers, had a good week again, down very slightly today, 0.89 of 1%, but making higher highs and higher lows, strong rising relative strength, continuation of strength in Canadian energy, continuation of strength in US energy stocks. In fact, relative strength for US energy stocks have been rising since October of 2020, really when the reflation trade began, but did certainly have consolidation between spring and fall and now into the next leg higher. The commodities to equity ratio, which has underperformed for many, many years, certainly has been turning, and that's continued. This is that Rji Index. Relative strength has been improving since the early part of 2020, outperforming the S&P 500. This is a group that's broadly underowned. It makes up only about 4% of the S&P, the basic materials companies. But the basic materials themselves certainly are supportive from a price perspective for those companies. Lots of areas of strength here, and it just continues. The important strategic metals like nickel and aluminum continue to firm up. Copper continues to firm up. The copper to Nasdaq stock ratio, again, which underperformed for many years, continues to improve. This is the Copper Producers Index going back to 2014. We broke out in 2021, pulled back, and now here we are starting our next leg higher. Many of these companies pay great dividends. In fact, this week, the entire metals and mining sector made a new high, both absolute and relative. Certainly no sign of weakness here. Agricultural commodities we've been talking about for quite some time. The DBA ETF, which is made up of a number of different soft commodities, continues to behave really, really well. Strong relative strength versus the S&P. In fact, there's another ETF, MOO, which is the companies that produce agricultural products, is doing exactly the same thing. The forest group continued to firm up this week, strong relative strength since October. And even gold finally broke out from its consolidation after almost a year of tightening this consolidation this past week broke out to new recent highs. It looks like the next leg for the gold bull market maybe has begun. Certainly there was some number of individual companies behaving much better than gold itself. And we've seen money flow there over the past week. So basic materials as a whole, and these are companies that all supply basic materials, anything from fertilizer to aluminum to steel to chemicals, very close to making a new high here and seeing nice improving relative strength versus the market. So this reflationary trade continues. Let's talk about a few other groups. Reopening appears to be a theme. The travel and leisure group has been seeing nice improving relative strength since the middle of December. Remember, we thought that once you could see an end to the wave in Omicron 3 or 4 weeks out, the market would start to price in improvement. We got some great numbers this week from Marriott, a number of the travel companies showing some real improvement. And this group looks like it may be on its way. The transport showing some improvement, again, an economically sensitive group. And when we think from a thematic standpoint, this is the Rpv Index, the S&P 500 Pure Value Index, making a new relative high versus the market going all the way back to last spring and very close to making a new all-time high versus growth, on the other hand. Maybe we didn't put it in. Growth trading well below the 50 and 150 day and 200-day moving average, showing no relative improvement whatsoever. So the themes continue. Technology underperforming as a basket. This were the lows in January, slightly higher lows on Friday, but below all the long-term moving average and weak relative strength versus the market, no real improvement. The one group within it that we thought probably does a little bit better than the rest is semiconductors. They were up almost 6% today, showing some relative improvement versus the S&P, but that would really be the only group within tech that we think stands out. And then when we look at the bond proxies, things that act like bonds, the utility sector, certainly not giving anybody any love, and the communications sector, which includes telecom and some of the social media companies, continuing weak, and healthcare continuing weak. So it continues to be a bifurcated market. There's the industrials, sort of neutral, not really much to gain. We got asked last week, what would it take for us to start building another position here? We need to see some improvement in this relative price strength. We need to see some improvement in breadth. And outside of a couple of small pockets in industrials, which would be transports and some of the defense companies, we're just not seeing it. So value over growth. Short duration over long duration. There's growth, there's value. So the question is, how are we positioned? This is something that we like to revisit every week. To be completely transparent, if you take all of the assets that we manage as a firm, 26% of all the assets that are in the equity market are in financials. That's a significant overweight versus the S&P weight. Energy continues to be very important at 15%, almost 5 times the market's weight. Materials are very significant weight. S&P only 2.5% in materials, we're at 14%. Technology continues to be a very significant underweight. One of the problems is when a group starts to underperform, that's outperformed for a long time, it can go on for a long time. And so we're very careful about pushing back in, hoping that we're going to find a bottom. Our view would be, let's stay with those groups that are showing us very clear leadership in the market. Outside of that, no other significant overweights. Industrials, a significant underweight. Consumer discretionary underweight. Utilities, an underweight. Healthcare, an underweight. Communication services, an underweight. So at the end of the day, we have to walk the walk. We have to do what our work tells us to do. We try to be flexible. We try to be dynamic. We try to look for change. And then we retest our base case every day and every week to say, do our positions continue to match up? Outside of our North American mandates, we're seeing some significant strength globally. When we look outside of the US, many global markets are now starting to outperform the US stock market. Part of that has to do with where the sector weightings are within those markets. In the UK, there's a lot of financial services and there's a lot of resources. And the UK market, since the middle of December, has been showing strong, improving relative strength versus the S&P. This is a very nice setup. And to me, it looks like it's about to break out and go significantly higher. Japan, we've been talking about over the last year as showing pretty good absolute performance, now showing strengthening relative performance versus the US. Mexico, nice relative outperformance since November, about to make a new all-time high. So you have Europe, you have Latin America, you have Asia, and you have emerging markets. All of these groups are groups that have underperformed anywhere from, well, of course, in Japan's case, for 30 years, to countries like Taiwan, 20 years, to emerging markets really since 2014. This is maybe a secular shift taking place within the equity markets from domestic equities to global equities and emerging market equities. So as you can imagine, they are becoming a more important part of our global macro portfolio. Global macro sector weights have been dominated by things like metals and energy and commodities, as we've talked about for the last many months. But what you'll see is that our weighting in emerging markets is rising. Our weighting in dividend growth has been rising. Our weighting in crypto is rising. Very strong outperformance this past week in crypto, made a high much higher than the January low, which is exactly what we want to see, and improving weighting in developed markets, Asia and Japan, and also Europe for European financials. On the short side, we continue to be short fixed income. This could go on for a long time, these rising rates, and this could be quite fruitful. So far, it's been quite additive to the portfolio. So the news is going to continue to happen. We think that the strength in energy and financials has really only just begun. And we think it's possible that tech and healthcare could underperform for some time. Now, we're not fixed in a view. We're going to keep testing this case every week. And as we see change, we'll report on it. When we look at what investors are doing away from Barometer, we see people voting with their feet. When we look at the close for the flows that have been taking place since January, significant flows, $11 billion, have come into value-oriented equities. Financials have seen $7.4 billion. Commodities, $6.2 billion. Energy, $3.9 billion. When we look at the other end of the spectrum, we're seeing lots of money come out of corporate bonds, lots of money coming out of growth, lots of money coming out of inflation-protected bonds, money coming out of discretionary, consumer discretionary. So it's a very bifurcated market. A few themes that we want to take away from that. There's money coming from the big pile of bonds into equities. And equities didn't see flows for a long time leading up to last year. We see money flowing into commodities. And we know in the last 5 Fed tightening cycles, commodities in general outperformed the S&P. We know that value in general does better in a reflationary environment. You can see the correlation, the 10-year yield versus the ratio of performance, value minus growth. Value is outperforming as yields are going higher. We can see that gold is improving and the flows are improving, but we're still a long way from being overbought. So underneath the surface, money is moving. It's not leaving equities and leaving commodities to go to cash. We know that money is coming from cash into equities and into commodities. Now, we will get defensive if our work changes. But as it seems, the broad themes that we see as leadership continue to lead. We're in a market where being targeted is valued because growth, which is underperforming, is a big part of the S&P. And some of the other sectors we talk about are big parts of the S&P. and they're just not providing returns. We think this is an active manager's market, and it looks that way from what we're seeing in the portfolios. So with that, if we have any questions, let's see if we can answer them. I don't have a moderator today, so let me have a quick questioning. The question is, do we have any concerns about the widening credit spreads? So if you think about it, a bond investor doesn't like to see rising rates, because as a bond holder, it means bond prices go down. As a bond issuer, you probably don't like to see rising rates, because it means your cost to finance goes up. If you are a company with lower credit quality, meaning that you have a less strong balance sheet and interest rates go up, it probably hits you a little harder than it does an investment grade company, because your cost of capital is going up. And if you have not as strong a balance sheet, that could be more problematic. So when we look at spreads, the differential in yield between what a corporate investment grade issuer has to pay versus a high yield or / junk issuer has to pay, we got to a point last year while the Fed was buying bonds hand over fist, where the spread between those two types of issuers was very narrow. In other words, a bond investor was getting very little extra return for taking more risk. If we look at the spreads today, they are widening, but they're widening back toward what would be typical between a high yield bond and a corporate bond. So no, at this point, we aren't overly concerned about the widening credit spreads, because we think that it's being driven by the fact that the Fed is going to take their foot off the gas in buying bonds. And we do think that there will be an increased cost to an issuer that's from the high yield area. As an investor, specifically in bonds, we aren't so interested in any of those camps. But at this point, we don't think it is putting stress on high yield issuers. It just means their cost of capital is going higher and back to where it has been historically. Any thoughts on investing in crypto miners for increased alpha versus crypto? Well, I'm going to say first off, I'm not a huge expert on the crypto miners. I think if you think about it, we need to know that there is new enduring strength in the cryptocurrencies themselves. And it looks that way. Let's see if I can share for a moment. If we were to take Bitcoin, for instance. So this is a shorter term chart, goes back sort of to last June. This is the decline in Bitcoin that took place from November through January. The January 24th low in Bitcoin actually happened 4 or 5 days before the S&P hit bottom. So one checkbox is that it bottomed early. The second checkbox is that when the S&P pulled back again last week, back toward lows, Bitcoin pulled back only slightly. And on the first sign of strength, it was up 3.5% today on a day where the S&P was up considerably less, up about 1.6. When we look at Ether, it's quite similar. Just remove this. You can see that Ether declined the same way, bottomed before the S&P did. The S&P bottomed on January the 26th, I believe. Rallied nicely, pulled back, made a significantly higher low. I'll like to see it trade back above the highs from a week ago before I got too excited about adding more. But frankly, that would be the first thing that has to happen. Then second, we need to see the ecosystem companies that are providing picks and shovels start to outperform. And it's just really maybe beginning. We'll have to see. So, I mean, certainly there's going to be lots of different ways to play this transition in the financial services, the financial system as it relates to crypto. I would focus now on the major currencies, because I do think from a longer term perspective, you know, they look quite attractive. Let's see if I can make a more normal chart. There we go. So, you know, we pulled back, we made a higher low. So in broad terms, higher high, higher low, higher high, higher low. It may well be we're seeing a significant turn here. I think that we probably are. I think that there's broader adoption taking place by investors, by institutions, by foundations, but I'm not sure I would go to the crypto miners yet. Okay, let me see. It looks like there may be another question. Do we have any stock sector specific concerns about the Fed aggressively reducing the size of the balance sheet during the tightening process? What the market dislikes the most is something that happens quickly. I think that the adjustment in share prices in January came as a result of the very rapid increase in 2-year yields. So here's the 2-year yield. And again, on a fairly short-term basis, October, the 2-year yield was at 1.24. Here we are at 1.57 today. That's a significant increase. The market has had to digest that. There are sectors that get hurt more by rising rates, and specifically, as we talked about, long duration assets like utilities, like high dividend paying stocks, like treasury bonds. You know, we're avoiding all of those things. In fact, as you know, we're short utilities, we're short fixed income in our macro portfolio. And we would be less inclined to be in things like communications, which again are long duration assets. We're less inclined to be in unprofitable tech. That's a problem. I do think there are sectors that get hurt by this. But on the other hand, there are sectors that have an ability to offset things. Companies, for instance, some of the large miners that pay big dividends, and as their profit goes up, their payout goes higher. So I do believe that it's going to be a market where we have to pick our spots. I think the Fed is going to be very, very careful about not rattling the market too much. The fact that Bullard has been out this week as a voting member of the Fed, talking that he advocates for more rapid and more significant interest rate increases. The Fed has a history of letting the outliers speak their mind publicly to let the market know what the outliers think. The Fed does not make a point of voting with the outliers, but they want the market to know what their thoughts are. I think that the Fed is going to be very careful and look at the data consistently to try to decide how rapidly to raise rates and to try and understand what the market can bear and what it can't bear. So with that, certainly happy to answer any other questions that you may have. If you would like to shoot an email in or give us a call, we can have a call directly about any other questions you may have. Certainly, I enjoy these calls each week, and I hope you do too. If you've got any topics you'd like to make sure that we cover, please don't hesitate to send in your questions, and we'll see if we can't either answer them ourselves or bring an expert on who can. So thanks so much for joining, and we'll look forward to seeing you again next Tuesday.